Hey guys, KYT with another video. And for this one, I want to talk about growth. In this video, I wanted to do two things. Number one, I wanted to examine this notion that many investors have that if you have a long time horizon or you're really young, you should expose yourself to growth stocks, whether that's true or not. And number two, I really wanted to clarify the concept for beginners because the word growth can be it's so general and it can be used so interchangeably in the world of investing that it can get a little confusing. So let's start with a basic definition. I think Investopedia does a great job for growth stocks. They are companies expected to grow sales and earnings at a faster rate than the market average, as opposed to other definitions of growth like portfolio growth. And I think the word growth, of course, associated with growing, might make beginners just new to market think that they have to own it because, of course, the idea is to grow your portfolio, but oftentimes it is to characterize a specific type of stock or company. One of the more common errors I see on Blossom is to associate one of the most popular ETFs out there, VGROW, Vanguard Growth ETF portfolio, as a growth ETF. And you can look at the breakdown on Morningstar. They're pretty good to break down whether it's a small, mid, or large cap type of ETF or value, a blend, or a growth ETF. And it's closer to a blend. And here the word growth is more of a marketing term to fill out the roster of all-in-ones, to present it in a nicer way for new investors versus something like Vanguard Growth ETF, VUG, which is actually a growth ETF, like very slanted in that area here. I think it's useful to check out Investopedia's webpage on growth stocks because their key takeaways section is pretty cool. I'll read through some of it. Growth stocks often look expensive, trading at a high PE ratio, but such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share price up. If you're new to PE ratio, it's just share price divided by earnings. So when you're comparing two different companies, one with a higher PE ratio means that their investors are willing to pay more per dollar of earnings because they expect future growth. So it can make sense when you're looking at NVIDIA, PE ratio of 71.20. For context, the S&P 500 oscillates between 15 to 25. It makes sense with the AI hype to have such a high PE ratio versus something that is a lot more stable, like 3M at 8.598. High PE just happens to be one characteristics of growth stocks. So just quickly looking back at VGROW, we can see its PE ratio on this website, 16.34, and VUG, that we said was more growth at 29.49. So it makes sense. Now let's wrap up and finish the takeaway section from Investopedia. Since investors are paying a high price for a growth stock based on expectation, if those expectations aren't realized, growth stocks can see dramatic declines. Growth stocks simply don't pay dividends, and growth stocks are often put in contrast with value stocks. Now, it makes sense to me now why growth stocks appeal to many investors. It has this high upside, its volatility, because of its high PE ratio, which suggests that it's based on high expectations of the future. And if those expectations swing in either direction one way, it can lead to dramatic climbs or dramatic falls in the stock price. With a better idea what growth stocks are, we can now tackle the question of whether it's good advice to tell investors, young investors, that they should tilt their portfolio more towards growth stock. Now, before I continue, I do want to say that the answer is different whether you're a diversified index, XEQT style type of investor versus a stock picker. I'll start with the index. Because when you're an ETF style investor, you're attacking the market with breadth versus concentration. You're not trying to concentrate your bets by picking just a few stocks to add to your portfolio. So it becomes important to look at whether growth is a characteristic, is in the factor world a risk premium, whether that characteristic gives you higher expected returns in the long run. Thankfully, there's a lot of people out there doing this type of research, looking for the next risk premium. So we have an article from Dimensional Funds, when its value versus growth history is on value side. Historically, value stocks have outperformed growth stocks in the US, often by striking amount. Data covering nearly a century backs up the notion that value stock, those with lower relative prices, have higher expected returns. And you can see this graph here. The average outperformance of value for all years since 1927 is 4.4%. Top of the graph is when value beat growth, and bottom half is when growth beat value. And you can see here, close to the pandemic, the 2000 and 2022, where tech growth stocks had that huge run-up, value greatly underperformed growth, but overall, value has an advantage. So that was the analysis of the past, but here we have Vanguard Capital Markets model forecast for the next 10 and 30 years, and US growth lags behind different types of stocks. Whether it's 10 years or 30 years, it projects US growth to have lower expected returns, but of course they each have a great deal of median volatility. So the result, of course, is not that deterministic, and but it's interesting to see that. When I read those findings, I am kind of like, how is that even possible? When I look at Meta charts and Apple charts, right? These are growth tech stocks that have done really well, but there's 2 points. There's growth stocks who have not stayed growth stocks the entire time and who have not generated this type of return. When we look at Intel, PayPal, Shopify, and Zoom, who became a growth stock during the pandemic. And then there are growth stocks that are not necessarily tech. For example, JCPenney was considered a monster and a growth stock and eventually had to file for bankruptcy. Sprint Corporation is another one in the telecommunications sector. So it's important to think about growth as a whole. But that's only if you want to attack the market in a diversified way. If you want to take a more active approach, it does tell me that you have to be really good at identifying these companies because there's only a small number of them that generate these insane returns. You have NVIDIA, killer day today as well. I come away with the idea that you have to know about these individual companies more than the fact that they're growth stocks. And looking at the trajectory of the growth stocks that failed, it seems like you definitely need to take an active approach and when to exit when you think those expectation is about to go down or the growth potential is not what it seems. It'll be interesting, like which Magnificent Seven stocks stay as good. I'd be surprised if all of them stay as good. And yeah, whether it's NVIDIA, we saw Facebook, Meta, we saw Apple, we've seen Tesla with a non-impressive start to the year, but we're just 6 months in. So looking forward to see how growth stocks as a whole continue to do and how these growth tech stocks continue to do. And again, it does make sense that for people that are gravitated towards that upside to individually pick some of these tech growth companies that they like, whether the strategy has a positive expected return on average. I'm not going to comment on that, obviously, but I wish people would take that strategy. Good luck.